And it's time for today's Wall Street Beat. Lazard CEO Peter Orszag penning an opinion piece in the Washington Post, laying out the case for President-elect Trump to keep Jerome Powell in charge of the Fed. And he writes, quote, the incoming administration should stick to preserving the Federal Reserve's independence, not in fear to Washington norms, but because practical evidence shows that independent central banks produce lower inflation. Peter joins us now. And Peter, you know, when you're thinking about not just what you wrote, this idea that the Fed should just do its job, right? But also about what role the fiscal plays in relation to the monetary. We've been seeing that push-pull already in the Biden administration, frankly. How much will you see it in the Trump administration with the threat of tariffs potentially driving inflation higher?
Well, I think one of the reasons why you've seen the long rate bump back up is because of concern that there are a variety of things that could be inflationary. But I would say the initial appointments, Treasury Secretary, I've known Kevin Hassett for a long time as NEC Director. These are very solid choices. And so there may be some tempering of the campaign promises that have been made in terms of their actual implementation. But directionally, many of the things that are under discussion would push inflation up, and that will make the Fed's job harder.
So over and over, all throughout the course of the week, and even since November, what you really heard from a lot of CEOs is pro-growth or deregulation. But if you think about tariffs or anything else that investors are actually afraid of, what are those things?
Well, first, I mean, on the regulatory front, we've also had appointments which I think do point towards the ending of the biggest bad era, not completely, but at least partially. And the biggest changes you'll see are on vertically integrated deals. That is where the biggest bad crowd under President Biden diverted the most from the traditional Robert Bork type view of antitrust. And therefore, that's where you're going to see the biggest move back. It won't be, you know, completely back to the way antitrust was done in the 1980s and 1990s, but it's clearly a different regulatory environment.
Well, let's talk about what that means for M&A. Obviously, we got the announcement of a new FTC chair. Lena Khan is out despite having the support of J.D. Vance. Andrew Ferguson is in, and it seems like everyone across Wall Street is saying that this is going to lead to this big M&A revival. Would you qualify that at all? What are you expecting in 2025?
Well, I think the most important thing is to realize the M&A cycle was building anyway, and private equity was becoming more active anyway. And so this is an accelerant on top of a cycle that was building anyway. So if you were counting just on this to spur a lot of M&A activity, I think that would have been a mistake. But it's coming on top of something that was already building. And so the first step was the end of interest rate increases, financing markets opening up, bid-ask spreads narrowing. And now we're starting to see, again, sponsors become more active, and then a change in the regulatory environment only adds to. So the environment for M&A looks really constructive as we go into 2025.
I love the Bork callback. I actually have Slouching Towards Gomorrah in the back of my car.
Okay.
I haven't cracked it yet. But,
We've been talking about a lot about Icelandic music. It's strange this year.
Let's talk about you. Obviously, were the head of the CBO and the OMB under the Obama administration. So just big picture, right? The hopes of Scott Bessent to bring our budget deficit down to 3% while continuing to grow the economy at a 3% rate. I mean, DOGE wanting to cut $2 trillion in spending. What kind of effect would that have on growth?
Well, first, I think we have to evaluate what's likely to happen. For example, there have been decades of attempts going back to, I was in the Clinton administration, reinventing government under Elaine Kamarck to find waste, fraud, and abuse. Every administration has a variant of this, and it comes in with a lot of hype, and then you get to reality. It's very hard to make substantial progress on the federal budget unless you're touching entitlements, Medicare, Medicaid, and Social Security, or defense. Interest is spoken for, and if you put all of those to the side, you're not left, you're left with about 15% or so of the budget. So it's often not as expansive as the rhetoric suggests. But I think at the heart of your question is, yes, if there was a massive move towards a negative fiscal impulse, that is a lot of budget tightening overnight, that would constrain demand and raise some risks about the growth
Even
targets.
over 4 years, Peter. I mean, can you really reduce spending by $2 trillion a year? over the term of the presidency?
I've got the under on that.
Yeah.
Well, and don't forget, I think the $2 trillion was at least ostensibly supposed to be per year, which is even more unrealistic. But
what about reducing the budget deficit to 3%? Is that, can you get us down to that in year 4 and still have growth?
It is very challenging to get down to 3% of GDP on the deficit unless there is a substantial uptick in growth. So I would kind of reverse it,
okay,
which is
I got it.
If we have a growth spurt, then the deficit comes down organically. But under current expectations about what the growth path looks like, it's going to be very challenging because we're going to be locking in lower taxes and because I think it's implausible we're going to be doing very much on entitlements.
Well, when you think about the fiscal picture here and that worry about growth, then how much do you have to worry about the potential for stagflation too? You saw a hint of that in this morning's data. Do you really worry about it?
Not particularly. I think fundamentally the economy is still quite strong. Yes, we had a slightly elevated weekly uninsurance claims number, but in general, the economy is performing quite well with the labor market holding up quite well and growth continuing. The U.S. is the envy of the world right now on the macroeconomy. So I think the big question on the stagflation front is not the stag part, but the inflation part and what happens on inflation. I would think if we don't do many of the things we were just discussing that would put upward pressure on inflation, inflation will continue to come down. But you can obviously do a bunch of things that are going to head it, make that head in the other direction. And that's why, by the way, it's not just saying that you're not going to even try to fire the Federal Reserve Chair, but also the rhetoric with regard to Federal Reserve independence. The point of the column this morning was to lay out the evidence on central bank independence for whatever other set of policies you're doing, producing lower inflation because of the credibility of the central bank relative to politicians.
And I do want to go back to the M&A landscape, though, obviously focusing a little bit more on Lazard, because you were saying, we were talking about that more favorable regulatory landscape coming into effect. But I want to marry that together with the economic outlook, because we talked about the risk of higher inflation. There's a risk that interest rates don't come down that much. So how do those two factors work together? The threat of continued higher for longer rates, but also regulation. Which outweighs which?
A couple things. First, before we get to that,
the
threat of tariffs also does lead to a lot of cross-border activity. So we're seeing a lot of interest from European companies wanting to invest in the United States in order to avoid even the threat of tariffs being imposed and locate themselves inside of the tariff wall. Now, on rates, look, lower rates are better for M&A, but I don't think it's the biggest driver. Often there are many other fundamental things, reach for scale, technological innovation, et cetera, that are tailwinds, and lower rates help, but they're, as long as we don't see a spike in interest rates, I think you're going to see the M&A cycle really continue. And if all we're debating is the rate at which rates decline, what I said earlier about a very constructive environment, especially with a return to a more traditional perspective on antitrust, will hold.
Well, it's interesting because even with this higher level of rates that you've seen, of course, we didn't see as many cuts as the market expected this year. You're still seeing a tremendous amount of capital markets activity. Tremendous. Lazard was an advisor this week, really, on a $2 billion loan that Blackstone provided to Dropbox.
Yes.
You're expanding well beyond M&A into these capital markets activities. What does this mean at the end of the day? Does this mean that kind of the markets are wide open and debt markets are flush with money and people will keep borrowing at rates like this and there's no worry about this kind of higher for longer environment?
Well, what I'd say is obviously financing markets are reopened, and that transaction that you mentioned is particularly interesting. We have something called Lazard Capital Solutions. It operates at the intersection of public and private credit and other financing markets. And that is what's really interesting is you're seeing more competition now. We've obviously experienced a massive growth in private credit. Public debt markets are also becoming, are reopened. And so helping our clients navigate the trade-offs and creating some competitive tension between those alternative sources of financing is a really promising vector for us.